Welcome to the Breakthrough Advisor Podcast. In this podcast, we inspire advisors with ideas and pathways to break through barriers and build a thriving retirement income business. We will interview innovative technology developers, business leaders, and successful advisors, then help you organize and execute these ideas to move your business forward.
Hey, this is Jack Martin. I serve as virtual CMO here at Simplicity InsurMark. I want to welcome you to the Breakthrough Advisor podcast today. We're super excited to have Ed Slott. Ed Slott's been with us a couple of times. He always brings the value and really delivers on the mission of our Breakthrough Advisor podcast, which is to level up your practice. This is where lead advisors from all around the country are coming. They're consuming this content on their schedule, which is why it's been so hugely successful. So, hey, welcome, Ed.
Good to be back.
How you doing?
All right, great. Looking forward to all kinds of things happening in the next year or so, and all the tax legislation and changes we had in 24. I'm telling you, it's almost getting obscene and not even fair that it's so hard with all these rules and regulations and changes and amendments and proposed regulations. It's so unfairly complicated to just take your own money out of your IRA anymore. And for advisors too.
Yeah, life's gotten a lot more complicated. Hey, before we dive into that, I just got a quick question for you. So we're sitting here post-election. This only happens once every 4 years. So what should advisors be thinking about now that it's clear what the next administration is going to be and so on? How should they be thinking differently about taxes, differently about IRAs, retirement? What changes because of the election in your mind?
Well, I don't have any inside information, but most people think or believe that the tax cuts that were set to expire after 25 will be extended. So what advisors should take from that is opportunity. Don't lay back and say, oh, good, we don't have to do anything. No, now you have more years to reduce these taxable IRA balances and move them into better vehicles, tax-free vehicles like Roth IRAs, life insurance. And the big takeaway is really the opportunity to get rid of these horrible assets. Due to the complications, IRAs are now the worst possible asset for wealth transfer or estate planning. They're complicated, they're expensive, the taxes are through the roof, and if you make a mistake, the penalties are draconian. It's just a horrible asset. So now you have more years to start trimming those balances at low tax rates. So don't sit back and say, well, we may have a few more years. Take advantage of those years and use those low rates to start trimming those balances and in the long run, helping clients. Now, when I say trimming balances, yes, that means taking that money down and paying some taxes, which some clients, maybe a lot of them, will balk at. But you have to see the big picture. You know, at year end, people are always asking for advice. How can I lower this year's taxes? What could I do now before year end? And I say, raise the taxes. Don't do all those things they tell you on every year end tax planning article or show. They say, oh, add to your 401k, you'll get a deduction. No, you're only adding to the problem. Go the other way. Remember, tax planning should be for life and beyond. If you're really doing a job for your clients, you're doing the full job. Saving them taxes now only costs them later when they could have had better options.
So I'm with you. I don't have a crystal ball either. But if we look at, what happened last time, this team was in charge, the stock market went a little crazy. So should we be thinking about asset location and capital gains and those kinds of things when we're thinking about our IRAs? If the potential is for the market, to continue this bull run, is there anything we should be thinking about with respect to which assets go in which kinds of accounts? What do you think?
Well, if you have a Roth and you want to get to a Roth, actually, the best assets to have there are the ones you believe that have the highest appreciation potential, your equities and maybe even the riskier investments. Now, there could be a downside, then you'd be a loser. But in general, the market will, I don't know. Again, nobody knows, but it will be rockety. It'll rock up and down, but it always seems to rock up and down when there's change in an upward direction. because businesses always make money or they're out of business. So the market generally, from what I've seen and everybody else has seen for 100 years, generally goes up. And I had this same talk with many people back in 2010. I remember that because that was a big year. Before 2010, you could not convert to a Roth IRA if your income exceeded $100,000. And then Congress needed money, like I believe they always will, and they eliminated that rule and the floodgates opened up. I begged people to take that deal then. Do you remember that deal, Jack? They allowed people like me, and I went all in. I did it myself. I converted everything. And I begged people. I remember being in programs on stages and a TV show. I said, take that deal. And now when I tell people, did you take that deal? I said, well, I took that deal. You should have listened to me. And I threw it out. In fact, even recently to a CPA audience, I said, so I converted everything in 2010. How much tax did I pay? And they're saying, well, you didn't give us the rate. You didn't give it zero. That was the deal. You don't have to make any calculation. It was zero. And they go, what? Yes, that was the deal. I converted everything. The deal was you paid no tax in 2010. Unheard of on a Roth conversion. You paid half in 11 and half in 12. So in other words, the government was so desperate for money, they gave everyone an interest-free loan to build a tax-free savings vehicle. So now, look back, and I did look back, the market at the end of 2010, back to your market question, was at about 11,000. We're 4x that now. And anybody who listened has all of that growth 4 times, all tax-free. And I think we may see the same trend again because people will be unsure. Yes, the market will go up and down, but I believe long run it goes up. Yes, we could see a crash, but it's very hard to time the market in anything, and especially with Roth conversions. I've seen comments online already. Well, the market's at an all-time high. It could crash. I don't want to convert now. All right, so maybe do a series of monthly conversions over time, kind of dollar cost average into the Roth. But in the end, the plan is to get rid of this highly taxed IRA because every time we have low tax rates, which we will have, I predict, in the new administration for more years, it also racks up the deficit and the debt levels, which could lead eventually to higher taxes. It's all a mathematical cycle. It's just that Congress lately, for the last, couple of decades, doesn't believe in math. But at some point, I believe the bill is going to come due. And now you have the opportunity, more years to remove these assets. An IRA is a horrible asset, but you have more years to get it into what I believe are the best assets for wealth transfer and long-term financial security and estate planning, like life insurance and Roth IRAs.
Yeah, and I think so. There's a little bit of a mindset shift that we've got to go through, right?
That's right.
People used to think, besides the thing about where asset location, we used to think Roth conversion, that's a one-time thing. But, the market doesn't go straight up. It goes up, it goes down, it goes up, it goes down, it goes up. All right, so why not convert on the dip? Why not build a program into your customer experience that says, hey, when there's a market dip, let's reach out to clients, let's convert a little, and let's get those assets moved over time. What do you think?
It doesn't really work. I had this with a client, I think it was back at the end of 18, and she was a Dr. Klein. I don't really do that much client work anymore, but back then I had a few clients left, and she was hemming and hawing the whole year. Should I convert? I have $1 million. I don't need it. She was a perfect candidate, but she couldn't pull the trigger. She calls me in December, says, all right, I'm going to do it. And she converts $1 million, and the market was on the dip. Well, by the time the order got through, it happened to be at that point, until I think recently we had a day that eclipsed that, the largest gain in history, over 1,000-point gain. She emails me 2 days later, says, I'm devastated. The market went up. And I said, what was the market? I said, what are you worried about? Well, I converted at the highest level. So I remember calling, and she called me. She did it already. She didn't go back. I said, just keep it. You're going to be fine. Markets go up and down, but they go up, and you'll always be better. A couple of years later, she had the same thing, wanted to convert another $1 million. And I said, all right, let me tell you what happened last time in case you don't remember. Here's the email. I saved it in your file. I'm devastated. How could I have done this? I said, look at the market then, because I made a note of it. It was 23,000. And now it was like 35,000. So what's the problem? So you really can't time it day to day. Because in her case, she thought she timed it on the dip, but by the time the order got processed, the market had gone up 1,000 points.
Can't time the market.
No, it's very hard to do with Roth conversions, but you can do it a little at a time. And you're right about that when you tell people, when I talk about Roth conversion, and this is important to explain to clients, a lot of them do believe it's all or nothing. No, you can do a series of smaller annual or even monthly conversions over time. So you like I said, dollar cost averaging into the market, but into a tax-free vehicle that the clients will love. And the life insurance. I put them both in the same area because the same bucket because it's such a great bucket. Anything that grows tax-free will always be better for the client long term.
The next generation, Generation X, the oldest part of that cohort is reaching age 60, 61, somewhere in that range, right? So how should they be thinking about this? I mean, they're in their peak earning years. So how should they be thinking about, their tax planning situation?
Jack, that is the number one question I get from advisors because they know I'm a big Roth advocate. And the reason I am is because tax-free is always better. In all my years of clients that actually listened to me and did the Roth conversion, not one client, and advisors have told me the same thing. They never had a client with a Roth ever complain. They look at their statement, and it's all theirs, 100% tax-free for life, no RMDs, no confusing RMD rules during life. Even after death under the Secure Act, the beneficiaries can do whatever they want for 10 years, all growing tax-free. So the question is always put, Ed, what about clients who are at their peak earnings years, which could be those top Gen Xers in their late 50s, early 60s, and they may say, well, I'm already in a top rate. And I say to them, nobody knows what the top rate is. That's the top rate now. And chances are anybody who's in a top rate now will be in a top rate for the rest of their lives because people that are at that level, that means they're earning, they're saving, they're not going to stop. And they might say, well, what about in retirement? Wouldn't I stop? Yes, but if you do nothing as far as conversion and just let it sit, the growth, the accumulation doesn't stop. That means you're accumulating, you're accruing a tax bill by doing nothing. And it could be that if the math ever catches up with Congress, that your top rate could go back to historic levels of 40, 50, 60%. Remember, the whole Roth, and I include the life insurance, the whole bet on taking money out of an IRA at today's historically low rates is a bet that rates in the future will be much higher. And I think that's a pretty good bet. And I always ask groups of advisors based on that same question you asked. I always say, poll the group, and I say, how many of you think taxes will go up in the future? And like half of them raise their hands. Then I ask, okay, how many think taxes will go down in the future? And nobody raises their hand. And I say, that's the same question. If it's not going down, it's going up, or it stays the same. Either way, I think the Roth or the move to life insurance, I put them in the same boat, is a winner long-term for clients and their families. And if the clients and their families win, so do the advisors every time.
So clearly the Roth conversion story is something we should be telling all the time.
Right. But people, it's not for everybody. I say everybody should at minimum have a conversation. Advisors should know who their clients are with the largest buildup in IRAs, because all that is building a tax bill. I say it in every seminar. Your IRA is an IOU to the IRS. It's building a tax bill, and you can't ignore it like the problem's going to go away. It reminds me of that old line by Henny Youngman, the old comic. He says, when I read about the evils of drinking, I gave up reading. The problem doesn't go away. It just grows. You can't ignore the problem.
Okay. So I think I get the Roth conversion conversation situation.
But there's a caution on the life insurance.
Okay.
Don't do it before 59 and a half, back to your Gen X. With a Roth conversion, you could do it any age. As long as you convert everything, you never have a 10% penalty. But when I keep saying it's the same thing for life insurance, not really. If you do take money out, you can't roll IRAs into life insurance. What I'm talking about is taking it down, taking advantage of low brackets. Every year you waste a low bracket, you lose it. It doesn't come back. Then you pay tax on the money, and you can use that money for life insurance premiums. Of course, I'm talking about permanent cash value life insurance like I have myself. But if you do that before age 59 and a half, don't do it because there's a 10% penalty. Then it's not worth it.
Besides Roth, at the beginning of the year, what are the 2 or 3 things advisors should be talking to their clients about?
Well, for the clients who are 70 and a half or older that are charitably inclined, you should do those QCDs, Qualified Charitable Distributions. People make the mistake of doing them at the end of the year after they've taken their RMD and thinking it can offset it, because there was a story even today's paper in the USA Today. It said you could do the QCD at year end and it offsets the RMD. No, it doesn't. It has to be taken first before the RMD. And this is only for clients who are charitably inclined. What I mean is they give to charity anyway. If you're giving to charity anyway, the best assets to give are IRAs because they're lousy assets. Give the charity the dregs. They don't care. They don't pay taxes. But do it in the right order. So people like to be charitable around the holidays, and they do it in the wrong order. They think, oh, it's Christmas time. Let me do a QCD. I'll give you a quick example. Let's say the clients, just to make the numbers easy, like already giving $5,000 a year to their favorite charity. But they already took, and their RMD also happens to be $5,000. So they already took their RMD, so they have tax on $5,000. Now they do a QCD, figuring that's going to offset that. It won't. You won't pay tax on the $5,000 went to the charity, but you're withdrawing $10,000. If you do it in January, that's why I say January is the new December. That's when you make your charitable gifts. You do the QCD first for $5,000. And then if your RMD is $5,000, it's already satisfied. So that's the way to do it. And that's the way to make gifts. You should go through your clients' tax returns, because especially in December when they're thinking about charity, tell them to hold off maybe and do it where they get the most bang for their buck. A QCD is a transfer from the IRA to the charity. The only downside, it's a great provision, and it's even been beefed up with inflation riders. The only downside is not available to enough people. It's only available to IRA owners and IRA owners who are 70 and a half years old or older. Even though the RMD age is until 73 now, there's even a gap. You can do it before RMDs kick in. And if they're making gifts anyway, they're getting no tax benefit out of it. Now you get the benefit of pulling that money out of the IRA at 0% tax.
So Q125. Thing 1 is Roth. Thing 2 is QCD.
Well, I would do the QCD first to get that out of the way. And
Right.
then if they're subject to RMDs, then they take RMDs and then the Roth conversion. If they're not subject to RMDs, they could do the QCDs anyway, just to get it out of the way, and then do Roth conversions. It's better to do Roth conversions before you turn 73, before the year you turn 73. Because they're more expensive to do Roth conversions when somebody is already into RMDs, because the RMD, the required minimum distribution, cannot be converted. You first have to take that out, pay the tax on it, and it can't be converted. Then once that's satisfied, and there's a new rule in effect now from these IRS regulations that once you take your RMD, you can't convert until you've satisfy the RMD for every one of your IRAs. Once you've done that, then any part of that remaining IRA balance is available for conversion. But it costs more because you had to take the RMD out and pay tax, which you couldn't convert. But if if you have clients that haven't hit 73 yet, say they're going to be 72 in 25, that would be the year to pile on Roth conversions. And another thing, which I mention all the time, the widow's penalty. You may have a client where one spouse, a married client where one spouse has died. That's going to happen in 25. So every advisor is going to have a couple where one spouse has died. Do the Roth conversion for the surviving spouse, because if you don't, the next year she'll be filing generally at single rates on pretty much the same income other than the adjustment for Social Security. To get that Roth conversion in on the last available year of married filing joint rates, which would be a lot less costly. Plus, you're doing that spouse a favor. And in all these scenarios, you notice when you take the money out, other than the QCDs, you are paying tax. But if you're getting it out at low rates, you're winning the game. Always pay taxes at the lowest rates. That's the key to all good tax planning. So if you do that, yes, the surviving spouse will pay the tax, but now she'll have a Roth IRA. Her income will be low for the rest of her life. She never has to take RMDs. And if she needs money for anything, she could take it from the Roth tax-free. And if she doesn't need it, she can stockpile it, accumulate it tax-free. And when she dies, it's accumulating her whole life income tax-free. It can go to the beneficiaries for another 10 years tax-free. So paying some tax now, you get something for your money.
So what's the third thing advisors should have on their agenda for Roth, QCD?
And I would look at life insurance, especially those Gen Xers, coming into their 60s. Use that IRA, turn it into a good life insurance policy. Like I said, the permanent policy, cash value, I have it myself. One of the best things I ever did. And I actually upgraded all my insurance about 10 years ago. I know that because I took a 10 pay and there's 1 year left. And it was a great deal. The reason I upgraded it, because it was about 10 years ago, I first learned about long-term care riders on life insurance policies. I don't know if that's available for you guys. You have that?
Yes, 100%.
And it's the best picture. I mean, especially now. I mean, you see the aging of the baby boomers like me. The medical care is off the charts. Even though I don't do much client work anymore, for tax work like I used to, even when I used to, in the last few years, it was not unusual to see older people claiming over $100,000 a year in medical expenses. And I had it with my own mother, the nurses' aides, the trips, even little trips in the ambulance to the doctor or the hospital, the home health care aides, medical home improvements are through the roof, installing ramps and railings and chairlifts and stair lifts and widening hallways and doorways and access, and medical home improvements like enhancing kitchens and bathrooms. These are big ticket items. Where is that money going to come from? People are worried about that. Well, with these products, it can come right from lifetime benefits of life insurance. And most people who sell life insurance they sell on the payment to the beneficiary. They don't care. I got to tell you, if I'm talking to advisors now, don't tell your clients about that the kids are going to get all this money. They already know that, and they don't care about the kids anyway. They tell you they do, but they don't really. They care about themselves. What's in it for me? Why? Because I get that when I do consumer seminars all the time. Ed, you talk about life insurance. Why would I do that? What's in it for me? I just pay everybody and then I drop dead. What's in it for me? And I said, forget about the death benefit. We don't care about the kids anyway. They're going to get plenty. All right? What's in it for you? Lifetime benefits. I don't think that's stressed enough by the average person talking to clients about life insurance. To me, that's the biggest single benefit. And the reason I did it is because if I need that kind of expensive care, the last thing I want to do is rely on my kids to come up with the thousands of dollars needed for my care every month. I want to know it's taken care of. And everybody should want the same thing. The kids are going to get plenty. So what? I'm spending their inheritance. They'll still end up with more. So I say to anybody watching that sells life insurance, sell the benefits to them. I don't think a lot of people know about these fantastic lifetime benefits.
So here's the other thing, and I'm learning this now with my parents and with my wife's parents, okay? And it's not just about the cash flow. It's about choices. There are so many people who need home care, need nursing home care, etc. Aren't enough people doing that. There aren't enough quality service providers or quality institutions where people can get good quality care. And so to find the good quality care, to find the home care workers who are really going to show up and do the job and care about you and your parents, that costs more. And so don't think that just because you've got enough to cover the average cost of long-term care in your neighborhood that you've done the job. Because when you see what average looks like, you are not going to be very happy. You're going to want to level up the care that you're receiving and certainly the care that your parents are receiving. So I would say you can't overshoot that number. And to your point, if there's a way to take dollars that you have allocated to produce a tax-free income stream, but to get the bonus of having those available for long-term care, that is a huge win. The more dollars you can put in that pile that you have access to create choice and options, the better off you're going to be.
It's funny you said that because I think it's the best product out there. And even my insurance guy years ago, when I was going through this, I kept telling him the same thing you said. He says, well, I could reduce the premium. I said, no, I want the highest premium. And he said, well, I could save you. Don't save me money. I want the highest. Well, why do you want? And I'm telling him, like, I said, take me right up to the MEC level, the modified endowment contract, up to that level where you start to lose benefits. Because I want to build as much cash in there. That's my purpose. So it's available if it's needed. So there's no burden on my family. And I tell this to every consumer audience, and you can use this line if you present to consumers. I'm talking to the advisors now. And I look at them and I see the reaction. I do so many. I've done these for 30 years. And you could see which are the reaction shots, so to speak. When I say, so I go through all of this and I say, the reason you're doing this is because the greatest gift you can give to your family is the gift of your own financial security.
Amen.
And then I just let it breathe and I see the reaction. Yeah, I don't want my, you could almost, it's palpable. You could almost feel it in the room. And this product in particular gives you that, along with annuities, other products that provide guarantees. Guarantees are so important. There's so much uncertainty. From what I see, just from my own perspective, you probably see the same thing. But there's an old saying, money is a coward. Money flows away from danger, risk, and uncertainty. It just flows away. Money flows to safety and certainty and stability and guarantees. That's where money flows as people get older.
Yeah, 100%. Hey, this has been awesome. I think I said hello and then we launched. So here's my final question. Okay, so as we're wrapping up, is there another one final nugget you want to drop to advisors, who are ramping up in Q1 25 so that they can have an awesome 2025? What would you say to them?
Well, we're going to cover this. You and I have a program coming up. Let me check my calendar. It's January 14th, webcast. And I'm going to cover a 3-step process you can use. I've used it in all our programs, but start out the new year using this. And then when you come on the webcast, you're going to come on and say, Jack, that guy, Ed, well, I did that and I picked up all this new business. 3 steps: identify, explain, and show. And it encompasses a lot of what I just said here and the whole rethinking of retirement, not to think minimum. Nothing ever happens good if you stick with just taking the minimum out and the least, trying to save taxes now for an explosion or a tidal wave of taxes later. Minimum wage is no good. Do you go to the gym? I want to do the minimum. I want best results with the minimum effort. That never works. Think maximum. How much can I get out? So they identify, explain, and show. Here's your hit list. You could start working on it before the year end. Identify the clients, step 1, who are at most risk. These are your critical care clients. These you need triage right away, January. Who are they? Obviously, the ones with the largest balances. They have more at risk in their IRAs. Plus, with the market this year in 24, I mean, they have to see their balances going up, but so is the tax bill. That may not be all for clients' money. They don't realize, they think it's their money, actually. You have to identify those people and let them know they're at high risk. Why? That's the second step. Identify, because these are people you're going to call and set up meetings with quick. Identify, explain why their current plan is on a disaster course. It's no good. It's not going to work, but we don't have to stretch IRA. They were taught, some people still think that's a thing. It isn't, hasn't been for years. All that money is going to be taxed in like I said, a tidal wave of taxation by the end of the 10th year after death. So explain to them why their current plan doesn't work. Specifically, look for clients who've named a trust as a beneficiary. Those plans don't work. This is where life insurance is a much better vehicle to fund a trust. And the reason you have to explain why their plan doesn't work, they have to realize they have a problem. Otherwise, they're not ready for the solution. So identify who they are. That's easy. The ones with most at risk, the highest balances. Explain why their current plan will lead to a tax disaster for them and their beneficiaries, and show them alternatives like we've been talking about. Roth IRAs, moving from what I always like to say, forever tax to never tax. Build up lifetime benefits and insurance policies like I did myself. And I would say before you do any of that, and this may be the best single piece of advice, I always tell advisors to do this, do everything I said for yourself first, for two reasons. To take care of your own house, to get it off the table, but also to have credibility. Like, you see the passion I talk about it like this, because everything I'm saying I did for myself and my family. I couldn't talk about it like this if I didn't experience it with my own mother, my own family. Because what's going to happen when the client says, I love this whole insurance thing. Oh, what did you do? And you say, well, I didn't do any of this. I'm just a loser. But here's what you should do. It does not have the impact, the credibility, the trust, the bonding that you need. Do your own plan, because it always works this way. This is my rule, even though I'm not a life insurance person, I'm a tax advisor, but my rule for life insurance professionals. Those who own the most always sell the most. You got to believe in what you sell. So I would do that first thing out of the gun. Then you can talk like I'm talking to your client when you have that conversation.
Great advice. As usual, spectacular. We're going to have to go back and listen to this like 0.5 speed in order to get it all in. So thank you very much. Hey, folks, this has been Ed Slott. As usual, spectacular. Lots of great nuggets. This is the Breakthrough Advisor podcast. Please like, comment, subscribe. Wherever you get your podcast provided by you, we're available. Look forward to seeing you again on the next episode of the Breakthrough Advisor podcast. Thank you very much.
Thank you for listening to the Breakthrough Advisor podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of InsurMark. The content has been made available for informational and educational purposes only.